Hi, good morning, everyone, and thank you so much for joining us here at our ETFestival 2023. My name is Wei Ren. I'm part of the research team at iFast, and today the key focus of my sharing is on the outlook for the rest of the year and also suggestions and how you can potentially position your portfolios for a challenging year ahead. So I'd like to just start off my sharing today with a quick recap of what has happened so far in equity markets. So I think equity markets have so far delivered quite good performance in 2023. So if you look at this particular chart that I have over here, so if you look at the performance of global equities, okay, despite all that drama that has happened in 2023, global equities are still up by 8.6% in the first 4 months of this year. And also, if you look at other developed markets like Japan, US, and Europe, all of them have delivered very good performance this year. And then you have the obvious outperformer on the far left corner, which is your tech companies. NASDAQ has been on a bull run in the first 4 months of this year, and it has clocked up quite a remarkable gain of more than 20% so far in 2023. So I think all in all, it has been quite a good performance for equity markets. But underneath this good performance, it's also a year that has so far been characterized by rising market volatility and also quite a drama-filled 2023 because inflation at this point, it still remains persistently stubborn. Despite the Fed's most aggressive rate hike campaign in almost 40 years. Economic growth is also slowing, and we also have seen a series of bank failures this year, not just in the US, but also over in Europe. Credit Suisse has collapsed as well. So despite all this, I think equity markets in general has had delivered quite a good performance. And then there is China. So if you look at where China is on this table, on a year-to-date basis, China is actually down by 1.1%. So I think China, for the past few months, they have been one of the best performing equity markets because of its reopening. But quite obviously, that initial optimism has now died down. And on a year-to-date basis, China is actually sitting on losses because concerns are starting to build over the sustainability of its economic rebound in 2023. So moving ahead, what kind of economic environment, what kind of conditions should investors expect for the rest of this year? I think in short, our expectations is actually for conditions to be to still be relatively challenging. And one of the things that we are expecting for 2023 is for a recession to materialize in the second half of this year. Over the past 50 years, whenever inflation rises above 5%, it has always taken a recession to bring it down. There is no reason why this time around it should be any different. Growth needs to be negative in order for inflation to come down. And on top of that, global monetary policy has never been so tight. It has never been so overwhelmingly tilted towards rate hikes. You just look at the Fed's current policy cycle. It is the most aggressive campaign in almost 40 years. And the last time that monetary policy was this tight, the end result was a recession. So this cumulative impact of the higher interest rates, it will eventually be felt in the wider economy. It will further slow consumer spending. It will also increase unemployment. Some parts of the global economy are already starting to feel the impact of higher interest rates. I think property market is a very obvious casualty. Except maybe Singapore's property market, which is quite resilient. But in other parts of the world, I think property prices have started to come down. The bank failures that we have seen this year, I think that's also another more obvious casualty of higher interest rates. So these bank failures, they have been, it resulted from the impact of all these higher interest rates. I think the good news for investors is that we don't think these bank failures, they are indicative of a financial crisis coming. I think a lot of these banks, they are very isolated cases. So we don't think that this is going to spiral into a broader financial crisis. But having said that, these recent bank failures are also not without negative consequences on the global economy, because what will likely happen is that financial conditions will tighten further because banks after this series of failures, what they will likely do is they will become even more conservative. They will tighten their lending standards. And what this also means is that the supply and the availability of credit, the ease of getting loans in the economy is going to be even more difficult for companies, especially the SMEs that are the lifeblood of the US economy. So we could potentially see defaults starting to pick up. And one of the things that I'd like to just highlight in this particular chart also is that leading economic indicators, okay, as you can see from this chart over here, is also showing a significant deceleration in economic activity. So I think there should be no doubts that we are heading towards a recession in 2023. The silver lining in all this is that your household balance sheets, your corporate balance sheets at this point, they are still relatively resilient. So that could provide a bit of resilience to the economy as we head into this recession. So our expectation at this point is for a recession to take place, but it's going to be relatively mild, and it will likely materialize in the second half of 2023. On the topic of inflation, I think our view on inflation is that it will probably remain elevated. And even if a recession does come in the second half of this year, there is no guarantee that inflation will come back down to the 2% target that will allow the Fed to start cutting interest rates. So there are a few reasons why we think that inflation is going to be more persistent than what markets are expecting right now. So firstly, is because the jobs market is still extremely robust at this point. There are still chronic shortages in the jobs market. So I think many of you may have read about the news about the mass layoffs that are happening in the US labor market, particularly in the tech industry. And some of you may perhaps be wondering, how come there are so many layoffs in the US, but yet the labor market has been so relatively robust? The reason for that is because these mass layoffs, they have been offset by a relatively robust demand in other areas of the economy, particularly those services-related sectors, like your hospitality industries, your restaurants, childcare centers, hospitals, all these kind of industries. They are still ramping up hiring over in the US. And this strong labor demand over in these industries have been more than able to offset the mass layoffs that are happening over in the tech industry. And on top of that, this strong labor demand in the US is also happening alongside weaknesses in labor supply. So as you can see from this chart that I have over here, which shows you the labor force participation rate. So labor force participation rate, it has been picking up, but at this point, it still remains below pre-pandemic levels. And what this actually means is that the workers that have left the labor force during the pandemic, they have yet to return to the labor force. And they may never return for a couple of reasons. Firstly, COVID-related deaths. Some of them have unfortunately passed away because of COVID-19 infections. They will not return. Number two, early retirements. Some people have decided to retire early, and these people, they are also not coming back to the workforce. Immigration has also been curtailed because of rising anti-immigrant sentiment over in the Western world. So again, the immigrants, they have been leaving the US, and immigrants have been a key source of labor supply over in the US, which explains why at this point, labor supply in the US is relatively tight. And this has forced many business owners to increase their wages in order to retain their workers. And this is critical because labor cost accounts for about 2/3 of inflation. So for as long as the labor market remains relatively robust, it will be difficult for the Fed to bring down inflation to 2% within such a short period. Now, second reason why we think inflation will remain elevated is because the drivers of the recent disinflation, they could be temporary in nature. So what do I mean by that? So take used car prices as an example. So used car prices, they have been on a steep decline, and they have been one of the key contributors to disinflation over in the US. But this could be about to change because wholesale car prices are starting to show that this category of goods is starting to see price increases. And if retail prices also follows the wholesale pricing, then we could potentially see renewed inflation for this particular category that has been so instrumental to the disinflation that we're seeing over in the US. Commodity prices, also another area of concern. Commodity prices, of course, has been on a decline over the past year and has also contributed to disinflation as well. But again, no guarantees that commodity prices will remain where they are throughout 2023, especially as China reopens. And OPEC now has also engaged in surprise production cuts in order to support oil prices. So any unexpected developments, any unexpected shocks to commodity prices is going to lead to another round of inflation. And last but not least, I think inflation is structural, meaning that it is not temporary. We do think that some parts of this high inflation that we are seeing right now is permanent in nature, and the decade ahead will likely be characterized by a shortage economy. Shortages in a couple of things. I think commodities will likely see shortages because of the many years of undersupply, underinvestment in commodity supply over the years. And what we will likely see in the years ahead is that oil and gas, they will still be needed, no matter what people say about them being high carbon fuel sources. Oil and gas will be needed. Metals will be needed in vast quantities because all your clean energies, all these EVs, your lithium batteries, all of these things need vast quantities of materials, raw materials, your green metals. But unfortunately, I think supply at this point is still relatively constrained. It will not be able to ramp up in time to be able to meet this increased demand for all these green metals. Labor shortages will persist, but this time around not because of COVID-related reasons, but because of demographic reasons like an aging population and slowing population growth. Deglobalization will also push up consumer prices. Globalization has been a key reason why inflation has been so low over the past few decades. But with rising geopolitical tensions, with our countries now starting to turn inwards and focus on self-sufficiency, then this shift towards deglobalization, what will happen is that there will be, supply chains will become duplicated, less efficient, production costs will increase, and ultimately, the ones who are going to bear this higher costs are people like you and me, the consumers who will bear higher prices. So it is our view that inflation will be elevated, I think not just in 2023, but quite likely that it will persist at least over the next few years, which is why we believe that Fed rate cuts in 2023 is very unlikely. Even if the rate hike that we have seen in the latest meeting is going to be the last one in its current cycle, I do think that the Fed will at least hold interest rates at restrictive levels and pivoting to rate cuts at a time when inflation is still way above 2%. I think that's not a scenario that we are expecting at this point. So we are not expecting interest rate cuts to take place in 2023. With recession coming, with inflation likely going to be more persistent than expected, I think our advice to investors is to adopt a more defensive positioning for their portfolios. So that means buying bonds for their portfolios. And with all these bank failures and with rising uncertainty over Fed policy direction as well, I think all the more reason investors should try to incorporate some bond exposure inside their investment portfolios. Now, bonds are actually very attractive. Okay, rising uncertainty is not the only reason why we like bonds. On its own, fixed income looks very attractive because if you look at where bond yields are at right now, they are at their highest levels since the global financial crisis. In the past, I think just a couple of years back, bonds were just giving us yields of about 1+%. So if you're an investor, looking to create a portfolio that gives you a regular stream of income, bonds are a poor choice. 1+%, it can't really give you anything. Which is why investors have been going into equity markets, buying things like your S-REITs, buying dividend stocks. So those were things that could give them decent income back in those days. But times have changed. Instead of 1+%, bonds are now giving you 4%. And if you're willing to take a bit more risk in fixed income markets, you can potentially go into your IG corporate bonds or maybe even high yield bonds. And these fixed income segments can potentially give you even higher returns than just 4%. So it is now possible to create a regular income stream with just fixed income assets. So bonds are very attractive at this point. And also if you compare bonds versus equities, on a relative basis, I think fixed income has also been increasingly attractive. As you can see from the chart on the right, which shows you the yield spread between equities and bonds. So this tells us, this gauge basically measures the amount of compensation that investors are getting by taking on equity risk. So if it's high, it means that equities are more attractive. If it's low, then bonds are more attractive. So you can see that this gauge is actually hovering at near historical lows, which means that investors who are now buying stocks, they are poorly compensated for taking on equity risk. So again, on a relative basis, I think bonds is something really worth considering at this point. But if you're not familiar with bonds, I think our advice to you is to at least try to incorporate some fixed income exposure into your overall equity portfolios, because bonds, in our opinion, it has been getting very attractive. So if you're interested to find out what fixed income options there are, so I think the first place to look at is our ETF focus list, as my colleague has shared just now, under the fixed income category. So I think this will be a good starting point if you're looking out for some plain vanilla fixed income ETF options. And I've listed them, some examples, over on this slide. Now, on equities, I know I said we are positive on fixed income, but just because we're positive on bonds, it doesn't always necessarily mean that you should stay away from equities entirely. A recession and high inflation, it does not always mean that equities will automatically do badly. So I think the key thing for equities is to really be selective in what you invest in. So if you're looking for ideas that can potentially hold up well even in a challenging macroeconomic environment, then one market that we would like you to consider is Japan. Japan is in fact our top pick for equity markets, and there are actually 4 reasons why we like Japan. So the first is because we think its economy is going to benefit from a full reopening of borders. Second reason, Japanese companies have very strong balance sheets. They are entering this potential recession with one of the largest recorded cash reserves and highest share of net cash listed companies. In the past, when interest rates were low, investors have actually penalized Japanese equities for holding too much cash, because this cash could have been better deployed elsewhere to get better returns. But as we head into a potential recession, this cash hoarding behavior, this cash pile that Japanese companies are holding right now, it has all of a sudden become very attractive, because this will provide much needed resilience for Japanese companies as we head into a downturn. Valuations-wise, I think Japanese equities are still quite attractive, not just relative to its own historical levels, but also when compared to other developed markets like the US and Europe as well. The bonus of investing in Japan is that you can potentially get currency gains as well from a yen appreciation, because the yen has dropped by so much last year, and it has made it very attractively valued at this point. And with the central bank also likely to embark on a gradual tightening over in Japan, then this could likely lead to further strength in the Japanese yen. So currency gains, I think that's a bonus if you do decide to invest in Japanese equities. For the US, I think we're neutral on it. The only reason why we're not going all out to promote US equities is really because we don't think it's very cheap. It is not a screaming buy in our eyes, but again, given the size of the US economy and the stock market, I think it's really hard to ignore the US. And we do have a couple of options for you to consider, because I think the key thing for US equities really is to be selective in what you invest in. So I think one of the areas that you can consider for US equity exposure is to go for the defensive sectors. I think that has been covered by my colleague in his previous presentation. So I think going for defensive sectors like your consumer staples and healthcare, this is one option, because these are sectors that offer goods and services that are considered essential and for which consumers will pay for regardless of economic conditions. If you're looking for equity ideas that can be inflation hedges, then I think commodity-related companies is something that you can consider. because the earnings of your commodity companies, they are naturally tied with commodity prices, which are in turn highly correlated with inflation. So by definition, commodity companies, they generally perform well when inflation rises, and that actually makes them a good hedge against inflation. So again, a couple of suggestions over here. You can find it under our commodity category in our ETF focus list. But if you just want one ETF that can give you broad-based exposure to the entire commodity space, then I think the Global Natural Resources ETF is something for you to consider. Another area that you can potentially consider is value and quality stocks over in the US. Value stocks are those that are attractively valued relative to fundamentals. So if your S&P 500 is overvalued, that also means that focusing on the cheaper and more attractive areas of the market is a prudent strategy. And quality is also something that we like as well. So quality stocks are those that have strong pricing power, market share, and balance sheets as well. So even if we head into a recession, even if inflation remains high at this point, I think the fact that these companies are highly profitable, they are able to pass on higher costs to consumers, I think that makes them relatively resilient as within the US equity market. So consider value and quality stocks. And I think the last group of companies that I'd like to highlight is companies that are generally beneficiaries of long-term trends like digitalization, AI, cybersecurity. I've listed two examples here, but for a more complete list of ETFs that can give you exposure to mega trends, do check out our ETF focus list under the tactical plays category, where you can find more ETF ideas that can give you exposure to trends like AI, cybersecurity, as well as cloud computing. Now, if there is one market that you need to avoid, I think it's China. We're still unconvinced with China at this point. We do agree that the worst is likely over for China's economy, but we do think that markets are too complacent about the sustainability of China's recovery. A few reasons why we don't like China. I think in terms of the timing of its reopening, China is reopening at a time when the rest of the world is slowing down, which also means that its exports industry will likely face headwinds in the year ahead. And this crucial pillar of growth that has held up the economy through the pandemic, it is now gone. Property market, I think, is also unlikely to stage a quick recovery because despite the government going all out to rescue the property sector, we have continued to see developers defaulting. Consumers, they still lack the confidence to buy properties, and I think most developers, they're still struggling to repay and restructure their debts at this point. So we have no doubts that eventually there will be a recovery, but this is going to be a long process, and which also means that it will be hard to replace this growth driver overnight. Bearing in mind also that China's property market, it consists about 20 to 30% of the overall economy. So it will be hard to replace this growth driver. But even if we are wrong about China's economy, if China's economy does exceptionally well this year, I think there are also longer-term issues to worry about for China, which includes a shift to a more top-down, state-controlled economy under the leadership of President Xi Jinping. Rising geopolitical tensions is also here to stay. And also the many years of abrupt policy shifts, I think it has severely dented business confidence. So a lot of foreign businesses, they are now less confident that their businesses will, their operations will not be disrupted over in China. So that has led a lot of companies to start shifting their operations away from China. The most high-profile one recently was Apple. So Apple has been in China for very long, but Apple too is also starting to hedge its bets. It is starting to shift its production facilities away from China into markets like Vietnam and India. So if you also agree with us that the China's long-term growth story is it's permanently impaired, then I think there are a couple of markets that you can consider for your portfolio. So I think two markets that I've highlighted here, these are markets that can potentially benefit from the shift away from China. One is ASEAN, the other one is India. But if you really must invest in China, I think our advice to you is to align your portfolios with China's priorities. So that means investing in SOEs and also companies in our favorite industries like your clean energy, EVs, semicons, as well as technology. If you haven't already realized, I think most of these companies that can benefit from supportive policies are your A-share companies. So if you want to invest in China, I think the opportunities are increasingly found in the A-shares market. But having said that, I think even if you invest in SOEs and companies in favored industries, that it is also not a risk-free thing, because the risk of investing in all these companies is that the government can change its mind anytime. In the past, there has been favored industries that have fallen out of favor. If it has happened in the past, it can happen in the future. So I think Chinese equities at this point, it carries a higher degree of risk in our point of view, and it is our desire that we advise our clients to underweight Chinese equities within their investment portfolios. Okay, so just to sum up what I've shared today, I think in a nutshell, we think this year is going to be challenging. We're expecting inflation to be high. We're also expecting a recession to hit in the second half of this year as well. So because of that, I think our recommendation is for investors to be more defensive. So more fixed income exposure inside your portfolios as compared to equities. For equities, I think it's important to be selective. Japan is one of the markets that we like in particular. For US equities, I think we like defensive sectors, value and quality, as well as beneficiaries of long-term trends. And for China, I think we don't like China in a nutshell, and we instead like markets that can benefit from the shift away from China, so particularly ASEAN and India. So with that, I end my sharing. Thank you so much for your time.